Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Oracle.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
For years, the story around Oracle was, pretty straightforward. Legacy database, high cash flow.
Right. That story is dead. It's over.
So what's the new story?
The central thesis now is that this company is undergoing a rapid, almost violent transformation.
Into what?
Into a hyperscale AI cloud platform. It's a huge pivot driven by, necessity and a whole lot of ambition.
A 50-year-old titan trying to reinvent itself.
Exactly. And the most compelling evidence that it's working isn't just the top-line growth. It's the massive contractual visibility they've managed to secure.
Okay, let's get into the numbers then, because that's where this gets real.
This is where the theory stops. So, their remaining performance obligations, the RPO.
Which is basically the backlog of committed money they haven't billed for yet.
Precisely. That number hit an astonishing $523 billion in the last quarter.
$523 billion. That number is so large, it's hard to even process.
It almost loses meaning. We're talking about a 15% increase just from the previous quarter. But, and this is the key part, the quality of that RPO has completely changed.
It's not the old legacy software contracts.
Not at all. That $500 billion backlog is driven by huge, multi-year AI and cloud infrastructure commitments.
From the big players, I'm guessing?
The biggest.
Yeah.
When you see contracts getting signed by Meta, NVIDIA, OpenAI, and xAI, well, it tells you something critical.
That Oracle's cloud, OCI, is now seen as a legitimate high-capacity alternative.
A viable one, yeah. It puts them in the same league as AWS and Azure, at least for these specific workloads.
But why OCI? I mean, these are the giants of AI. They can go anywhere. Why are they dumping billions into Oracle's cloud?
It really comes down to capacity and economics. OCI has been incredibly aggressive in building out these massive, dedicated GPU cluster environments.
So they have the hardware when others are constrained.
They do. And they're often offering it at better pricing. Plus, their contracts are flexible, and they have that crucial hook.
The database.
The database. All their existing enterprise customers need to run these new AI models against their existing Oracle data. So they're leveraging that dominance to sell the infrastructure. It's a powerful one-two punch.
And it proves that this AI demand is sticky. It's not just a passing trend.
When a company commits billions to an RPO figure like that, it provides a downside hedge that, very few high-growth tech stocks have. It de-risks a huge chunk of their revenue for the next 5, maybe 10 years.
Okay, so the RPO gives us confidence in the top line.
Yeah.
But we have to talk about the bottom line. This strategy seems to have created this huge financial split in the company.
It has.
Yeah.
Historically, Oracle was a financial fortress. You just have to remember that.
Right. I mean, for fiscal year 2025, operating margins were, 42.5%? Incredibly disciplined.
Consistently one of the most cash-generative companies in the entire software space.
Yeah.
Huge free cash flow. And they always rewarded shareholders.
A stable dividend, massive share buybacks, $11 billion authorized in FY 2024 alone. I remember that. The highest in their history.
They were the very picture of stability and capital return.
But that machine has now been, repurposed?
It's been put into overdrive. It demands a short-term sacrifice for that long-term growth.
And that's the trade-off.
That is the trade-off. You can't build a global AI data center footprint at this scale without just colossal capital expenditure, CapEx.
So what are we talking about realistically?
Independent analyses,
Right.
People who track this sector are projecting that this build-out is so massive, it'll probably lead to 3 years of negative free cash flow.
3 years of negative FCF for Oracle. That is a seismic shift.
It is. And with that investment comes a massive leveraging of the balance sheet.
This is the elephant in the room.
Absolutely. This is what investors need to understand. To fund this, to meet the demand that's in that $523 billion RPO, the company is expected to take on potentially $200 billion in new debt.
On top of what they already have.
On top of existing liabilities, yes.
That's an incredibly aggressive move. It puts so much pressure on their execution.
It's a bet. They are sacrificing their historical financial strength, the cash and the clean balance sheet, for the chance that OCI revenue can explode.
From what, about $18 billion now?
Roughly, yeah. To a projected $144 billion by fiscal year 2030. If they hit that, well, the sacrifice is justified 100 times over. It'll translate into massive future cash flow.
It's really one of the biggest strategic bets a legacy tech company has made in a long, long time.
It tells you that management has near absolute conviction that AI infrastructure demand is effectively infinite for the next decade.
And we have seen signs that they're being disciplined with this spending, right?
Yeah.
Making sure every dollar goes where it needs to.
Yes, the sale of their non-core Ampere stake earlier this year for a $2.7 billion gain. That speaks directly to that discipline.
Ampere was their in-house chip design project.
It was. By selling it, they sent a clear signal. They're not competing in the silicon design race against NVIDIA or Google. Instead, they're focusing that capital squarely on data centers and the software that runs on top.
So they're choosing to be hardware buyers, not builders.
And funneling that money into building out their cloud capacity faster, it's a smart strategic choice.
Which brings us to how they're positioning themselves against the giants, AWS and Azure. They still have their classic moat, the database dominance, but what's the offensive move?
Well, the classic mode is still as high and wide as ever. Over 90% of the Fortune 500 still run on Oracle for mission-critical data. Switching is it's too costly and too risky.
But that's defensive.
It is. The offensive play is multi-cloud.
And the growth numbers, they were wild, weren't they?
Staggering. Their multi-cloud database business was the fastest growing segment last quarter. It showed 817% growth.
800%. For a company this size, that's hypergrowth.
It is, and the strategy behind it is really the key. They are effectively turning their rivals into distribution partners.
How does that even work?
They are embedding Oracle multi-cloud data centers inside the physical footprints of AWS, Google Cloud, and Microsoft Azure.
Wait, hold on. They're putting OCI servers and clusters inside their competitors' own data centers.
Literally. It's disruptive and almost unprecedented.
What does that do for the customer?
It allows their enterprise customers to run OCI services while staying on their preferred cloud platform. It instantly expands Oracle's addressable market and solves the huge headache for CIOs.
So it's a database anywhere approach.
Exactly. Which brings us back to their hardware neutrality. We talked about them exiting chip design, but why is being chip neutral an actual advantage in this AI race?
Good question.
In this environment, capacity is everything. The AI hardware world is changing weekly. NVIDIA is on top, but AMD and Intel are pushing hard. By being neutral, by buying from everyone, Oracle achieves two things. First, they reduce supplier risk. They aren't held hostage by one vendor's pricing or supply chain. Second, and this is more important, they can rapidly adopt the best-of-breed chips the moment they are available.
So they can pivot faster than a competitor who is locked into an internal design or a single supplier.
Much faster. It ensures they can always offer the highest performance to those big-money customers, like Meta and NVIDIA.
That flexibility is a powerful differentiator when GPUs are so scarce. So let's look at who else is buying into this. If the thesis is solid, we should see insiders and institutions getting behind it.
And the data shows that institutional conviction is extremely high.
Yeah.
Total institutional ownership is now at 78.6%.
And we're talking about the big funds.
BlackRock, Vanguard, Fidelity. They've all significantly increased their positions over the past year. They're clearly betting on this multi-year AI story playing out.
What about the insiders? People closest to the action.
Their activity is very telling, especially during a period of rising debt. We saw CEO Safra Catz buy 150,000 shares back in January 2025. Then the CFO, Christine Huguet, bought 50,000 shares in February.
And just as important, no one is selling.
Critically, no insider sales reported since Q4 of 2024. When the people who understand the execution risk best are buying shares during peak financial stress, that's a powerful signal.
It is. Okay, so for investors following this, what are the next big events, the near-term catalysts we should be watching?
The next major date is confirmed for July 22, 2025. It's a critical doubleheader.
A 2-for-1.
First, we get the Q1 earnings release. The market needs to see that OCI growth staying strong, ideally above that 34% rate we saw last time. Confirmation of acceleration is key.
And the second part of that day?
Also on July 22nd is the Oracle 2025 Analyst Day. We expect them to give a lot more detail on the software layer.
What are you expecting specifically?
We're looking for the unveiling of new autonomous provisioning for LLM training environments. This is important. It's not just about selling raw GPU power.
It's about selling high-value software that makes the hardware easier to use.
Exactly. It makes OCI stickier, faster, and easier for these massive AI projects.
Beyond that date, what else?
Continued global expansion. The ongoing opening of new cloud regions, like the one just announced in Turin, Italy.
Yeah.
That signals they're keeping up with capacity demands to burn through that huge RPO.
Makes sense.
We've covered the bull case pretty heavily, but to be balanced, we have to address the risks. The bear case.
Absolutely. The risks here seem pretty substantial, tied directly to the size of this bet.
The primary concern is execution risk, coupled with that massive balance sheet leverage. If AI demand slows down or if they fail to execute on the build-out, the returns on that debt-funded investment could be, well, a huge disappointment.
And the market is sensitive to that. The stock had that sharp 37% pullback from its highs recently.
It did, which just underscores how reactive investors are to any hint of a slowdown in AI sentiment.
So for you, the listener, the key question is how this bull thesis mitigates that staggering risk.
It's mitigated by two interlocking factors. First, that $523 billion RPO. It acts as the ultimate downside cushion. It guarantees a highly predictable revenue stream for years.
So it provides a floor during volatility.
It does. And second, their core revenue structure is just inherently resilient. Even with all this spending, 87% of Oracle's total revenue is recurring. It's subscriptions, it's software support.
That ensures the lights stay on.
The lights stay on, and the debt gets serviced, even while they invest aggressively.
What about the margin pressure, the concern that this low margin or even negative margin OCI business will drag down the whole company?
That risk, I think, is already largely priced in. Management has given guidance that OCI operating margins are expected to turn positive in fiscal year 2026.
So the market is looking past the peak spending cycle, which is happening right now.
It's looking toward the eventual operating leverage and scale that kicks in once the infrastructure is built and being used. The short-term pain is priced in for the future gain.
So Oracle presents this really unique and compelling case. It's a company making a colossal short-term financial sacrifice,
3 years of negative cash flow, massive debt.
all in pursuit of a potential 10x revenue expansion in its most important segment.
The question you have to ask yourself is, do you have the conviction to look past those near-term pressures and invest alongside a management team betting billions on this transformation? Are you comfortable with a long-term bet that hinges entirely on the sustained, unprecedented demand for AI infrastructure?
Make sure you subscribe and hit the like button so you don't miss our next analysis right here on Smart Wealth with Joshua.